Hello, everyone, and welcome to Forte Financial Mortgage Group podcast. This week, we're going to discuss 2025, how we're saving people money in this crazy rising interest rate environment. We're going to talk all about that today. We have Anthony Campanaro, our sales manager and senior loan officer. Anthony, say hello to everyone.
Hi, Bertie. How you doing today? Looking to make a really good year this year. With the new election, I think everything's going to look forthcoming. Interest rates will start to come down, but right now I think home equity lines of credit is where it's at.
Yeah, thank you, Anthony. We're going to talk about what we're doing creatively because if you have been following our previous podcasts, a lot of our borrowers who purchased in the last couple of years have been waiting for rates to come down to take advantage of our FFF program, right, Anthony?
Yes.
We have been advertising like crazy where we refinancing for free. Now, rates, let's talk first about what's going on. You know, people really just don't understand. They see the Fed cut rates 4 times last year from September to December, 4 rate cuts. Well, actually not 3 rate cuts, but the first one was 50 basis points, so 1 full percent. From September through December, we had 3 rate cuts equaling a full percent lower in rate. So most consumers assume that mortgage rates got lower, and unfortunately, that's not true. Unfortunately, the 10-year Treasury yield is the main data point that long-term rates, like 30-year fixed mortgages, follow. And in September, actually, the 10-year Treasury was pretty low. It was down to about 3.6, if I remember correctly.
Mm-hmm.
And it has shot all the way up to, getting close to 5,
Yes.
very recently. So a lot of people are not as of right now, going to be able to refinance their loan to lower the rate and save, although we do have a couple of very creative options for actual refis. But you mentioned it before, HELOCs. So first off, and I'll explain this, and then we'll go into some particulars. There are mortgages that have come down a lot in rate, and this is where we're able to save people money. The rate that came down was the Fed funds rate, which is when you see the Fed cutting or raising rates, they're cutting or lowering the Fed funds rate. And the Fed funds rate is tied directly to prime rate. And 99% of all HELOCs throughout, all lenders are based on prime rate.
Mm-hmm.
So all of Forte Financial's HELOCs have all come down a full percent, okay? And aside from just that, and I'm going to let you explain to our viewers what we're doing special, but aside from that, we have some incredible improvements to our programs aside from just the rates with documentation types and, how we're doing them, self-employed, how we're doing bank statements, investment properties, all that good stuff. So we have created some incredible solutions to save people money. Everyone has credit cards. They want to do home improvements, where refinancing right now may not be the best option. In a lot of cases, it may still be, but in a lot of those other cases where people just, they don't want to do that right now, we can save a lot of money on HELOCs. So let's start with that. Anthony, tell everyone about what we're doing, please, with our HELOCs. What's so good about them, and what's new, documentation type.
Well, 100%, James, you're 100% correct. Right now, to take advantage of the equity in your home, everybody knows we just went through all the holidays. Everybody jacked up their credit card bills. Well, guess what? Even though the interest rates are high right now, the value of your home probably rose exponentially, which means you can utilize the equity in your home to go ahead and pay off the high credit card debt that you use throughout the holidays just to live these days because everything is more expensive. So with that being said, we have programs for the typical W-2 borrower, self-employed borrowers, all types of borrowers, all different types of income scenarios. So if you're not the typical W-2 borrower where you get paid weekly, you got a salary, and you're self-employed and you're making a lot of deposits, but you write everything off, well, we could utilize business bank statements as a source of income. 12 months, 24 months. We'll take the average and we'll take a 50% haircut on what the deposits are. What I mean by a 50% haircut is that, let's say you deposit $1 million over the course of a year, where we're going to give you credit for 500,000 of that as your income. Unless, of course, you have a CPA, an accountant, who's willing to say that your expenses are less than 50%. Maybe they're 30%. And then we can qualify using even more of your income deposits. So plenty of different programs. This definitely does not discriminate against anybody. And I think more people should know about the home equity lines of credit and take advantage of them now while the values are high.
And let me stop you there. That's a great point. So the thing is this, with our HELOCs, our home equity lines of credit, also, let me just clarify. This podcast is mainly about second mortgages, okay? A HELOC, or home equity line of credit, is a form of a second mortgage. All right? I just want to educate, because we've been getting a lot of questions lately through TikTok about what second mortgages, and people saying, well, what's a second mortgage? And we do it every day, so to us it's obvious, but someone who is not doing this, not in it, they don't really fully understand. So a second mortgage is actually a second lien on your house, on your against your house behind your main mortgage that you got when you bought your house, or you refinance that or whatever. So you now have two mortgages. That's considered the second. The second is the one that was taken out after the first. Okay. But as far as that is all concerned, it's the equity part is huge, because if things do change, and here's the thing, we have no idea what's going to happen at this point. We have our own predictions, which we can get into, but at the end of the day, nobody can guarantee if homes are going to keep going up or they're going to drop. Nobody can predict, is the stock market going to crash now? Are we going to go into a bad recession? You can't, okay? So the best thing we can do at this point is use the tools we have today to put ourselves in the best position. And a HELOC right now is the best tool that we have, because rates have come down significantly. I mean, prime rate was 8.5% in September. Now in January 2025, it's down to 7.5%.
7.5%.
So, and our terms, our pricing is just improving aside from that with what we can do. So, feasibly speaking, somebody can get a HELOC right now, get a rate, in the 7s to 8s, depending on their parameters are all a little different, how big the line is, how much they need, what the loan to value ratio is, and pay off their, I just spoke to a borrower yesterday. He's like, James, I just need to pay off all these. I have a 22% credit card. I have a HELOC that's at 11% that he got, so we're like, okay, well, we can pay all that stuff off, pay off all your credit cards, pay off all your bills, and you're going to have a rate that's significantly less, which is great. So anyone that's looking to pay off bills, do those home improvements, spring's just around the corner, for whatever that may be, reach out to us. We're closing, Anthony, right? 7 days?
Seven
to finish?
10 days, sure.
99% of our HELOCs were no appraisals.
No appraisals.
Right?
We have a great tool that we utilize to look and see where your value is. And if you feel that you're comfortable with that number, of course, we can utilize it, not have to do an appraisal, and just quickly get your loan closed. Lower title fees. Look, you have equity in the home. Now's the time to utilize it. Even if you're not going to use the money, take the line of credit now, because one day you might want to make an investment, another property, buy an investment property, whatever it may be. But again, as James was talking about, the second mortgage, you have a HELOC and you have a HELOC loan. So a HELOC is a line of credit. You're not going to pay interest on it unless you're using that money. A HELOC loan is going to be a fixed rate second loan. Now, of course, a HELOC is adjustable, but based off of the prime interest rate, which has gone down, as James mentioned, 1% over the course of this year. We expect that it will continue to go down. Again, we don't know where the fixed 30-year mortgage rates are going to be, but for now, let's utilize the equity in our homes.
Thank you. Yeah, we can always, you can save money now. Like, you don't have to just wait until rates go down to drop your whatever 7% mortgage rate down to 6 or 5.5 to save money. You may have bills, you may have other debts outstanding that we can consolidate now because these HELOCs and second mortgages have gotten a lot cheaper, where mortgage rates have gone up. Consolidating everything else. If you're interested in that, just visit our website, fortefinancial.com, submit your loan application, and it's a very fast and easy process. And by the way, too, costs. A lot of people say, oh, closing costs. Most of the HELOCs we're doing right now are just minimal title and recording charges. Like, they're very inexpensive, and plus with no appraisal fees. So in most of our cases, there's sometimes no origination charges, nothing. It's just title and recording. Not all, depends. Every deal's different. Every scenario, every credit score, depending on what state. Now, let's just say the states that we are licensed in and able to do these HELOCs for our borrowers, for our viewers listening, we're able to do these in Connecticut, New York, New Jersey, Massachusetts, Pennsylvania, North Carolina, South Carolina, Georgia, Florida, and Texas. Those are the 10 states we can do second mortgages or HELOCs in. But Anthony, you mentioned, I want to clarify that because this is huge, and this is a good time too, because this is tax time, right? A lot of people are with their CPA right now. They're doing getting their stuff together to do their taxes. This is the time to look at this too. And many people don't realize that they can get a HELOC that are self-employed. You mentioned before. So it's called alternative documentation. So for self-employed borrowers, instead of giving us your last 2 years of tax returns and us using that to figure out if you qualify, honestly, many self-employed borrowers don't qualify for any mortgages based on that. And for the longest time, there was no second mortgage product for alternative documentation. So now there is. Now we're offering this. And the terms are great too. The terms are great. Where the rate's not that much higher than someone with W-2s. It's not that much worse. It's a little bit higher. A little bit, not a lot. Fees, not that much higher. Really almost the same. So in those cases, you're just getting us the documentation that Anthony mentioned, your bank statements, and it's very fast and easy. So now's the time to take a look at that. And yes, we are offering HELOCs on investment properties. Many of you guys have been asked, see our HELOC videos from before, asking investment. Yes, absolutely. ForteFinancial.com, submit your application. Or if you just want to have an idea of what it's going to look like, right? We tell them, just listen, we don't want to get on the phone, spend a half an hour, get all your information. We don't want to do that to you unless it's something that sounds like it may make sense. So the easiest thing to do, send us an email, info@fortefinancial.com. Just send us an email there with a copy of your current mortgage statement, whether, for whatever is your first mortgage, and just tell us what you're looking for in an email. And we're not going to pull your credit. We're not going to, ask you 1,000,000 questions. We're going to, with that statement, we will run our internal due diligence we'll tell you what value we're going to use for your home with no appraisal right away. So we can tell you, hey, we're not going to need an appraisal, and here's approximately what this is going to look like, assuming A, B, and C. We're going to give you what that criteria is. Your credit is excellent. Whatever, your debt to income ratio is good, and you're looking at loan to value, your line amount, and all that. So we're going to give you an estimate of what this looks like without you having to fill out a full application and talk to us for an hour. We don't want to waste our time either if it doesn't make sense for you. So that's just our philosophy here.
And as James mentioned, the states that we are licensed in to do those HELOCs, HELOans, if we're talking about an investment property and we're doing a non-QM, which is a non-qualified mortgage, alternate doc program, well, we can do those on investment properties as business purpose loans in any state out there. So doesn't have to be one of the 10 states that we're licensed in. Again, this is for an alt doc investment type property, so a business type loan. We can still do those home equities, whether it's fixed or home equity line of credit.
Good point.
Plenty of options,
Basically,
for everybody in the country.
What he means is, like, if you have an investment property in the name of your LLC, that's considered business purpose, and we are writing those in pretty much every state in the country. So, yeah, that's a good point. Yeah. So HELOCs, reach out. We're doing them, closing them lightning fast. Just something to keep your eyes on. Some of our competitors are offering these HELOCs. Oh, we'll close in 24 hours or 2 days. And those lenders that are doing this, be very careful. First off, the rates are significantly higher than what we're doing, and you're paying a lot of closing costs for those. I've talked to borrowers who've talked to these other mortgage lenders doing these things. We're doing a pretty similar process, but it's a more traditional underwrite. We just do it really fast, where it takes us about 7 days to close with no appraisal. That your rate's a lot lower than these competitors that we're talking about, and your closing costs are a lot less. So just be careful. If you hear someone say, "Oh, we can do a HELOC for you in 24 to 48 hours, you're closed," that those loans are very expensive. Take 5 more days and get it a lot cheaper and a better deal. Okay, we're not talking about a $5,000 personal loan here. We're talking about what could be $100,000, $200,000, $300,000. But Anthony, there's another program that I want our viewers to know about. That a lot of people that want just forget about HELOCs. Maybe they don't have the equity. First of all, let's clarify. Right now, we're going up to 90% of the value of the home.
So combined loan to value between your first and second mortgage.
So let's just use an example of a $500,000 value home. You have a $300,000 first mortgage, right? The maximum total liens you can have is $450,000 on this example. So if you have a $300,000 first mortgage, that would leave you with up to $150,000 in a HELOC. So up to 90% is what we're doing right now. Just to clarify.
Sure.
But there's something very unique that we're doing, which opened up, which is something that is for those people who need to save money off their mortgage right now. They just need to save. We are offering a refinance buy down, where just like a lot of people don't even know about this for purchases because it's not new. I mean, this purchase buy down, this came out, after rates really started to go up in 2022 is when these programs started coming out more, where you would buy the rate down temporarily with closing costs. So we're offering this for refinances. So I just want people to be aware it's become very popular recently. So we can do this for you. The way it works is, there's a few variations. Well, let's just say it's a 1 year buy down. And let's say the rate would have been 6.75%, the normal rate that you would get right now. I'm not saying that's your rate. It has nothing to do. Every loan to value, loan amount, credit score, LTV, what state you're in, all those things would play a big factor on what the rate would be today. But let's just say we said, hey, the rate today is 6.75. So what we could do is a 1% buy down. We can give you a 5.75% rate with a buy down, which can be financed into the loan. So basically, the difference in the payment on your mortgage between the 5.75 and the 6.75 per month, let's just say, that's going to be a pretty big. It could be $300. Let's just say it's a $300, right? That $300, times 12 is $3,600. So for 1 year, that difference would be $3,600. What we'll do is we'll collect that money from you in the refinance, in the loan, at the closing. It will be put into a special escrow account for you. So every month, for the next 12 months, the money, the $300 difference comes out of that towards your loan to give you that lower rate. So you basically would save an extra $300 a month in this example for the next 12 months. So for those people who are like, I need to save now, I don't want to wait another 6, 12, 18 months until it makes sense to refi, this might be a good option for you if you need to save, because the thing that's cool about this is that that's your money, okay? A lot of people think, oh, if you do it now and then rates drop, and we want to refinance, and in the next couple months we lose all that money. That's not true. So what happens is, let's say we want to refinance you in 6 months. Okay, half of that money will have been used at that point because it brought your loan down for 6 months, and you probably still have another $1,800 sitting in there.
Mm-hmm.
That money is refunded back to you. Okay, it goes off of it will be subtracted off of your loan payoff.
Off your payoff. Mm-hmm.
So you will get that money back. So it's actually to your advantage to refinance out of that sooner than later if rates drop, because you get that money back. But it also guarantees for the next 12 months, hey, I'm saving that extra $300 a month. Again, in that example, everyone's example is going to be different. If you're interested in seeing what that looks like for you, just reach out, fortefinancial.com. Email us a copy of your current mortgage statement. That's the easiest way for us to run numbers for you without getting into a full, we like to just give the borrowers, consumer, an idea of what it's going to look like before everyone goes through a whole process. Because, what's the point? What's the point of spending time? Even though we make the application fast and easy, we like to make it even easier. So reach out if you're looking forward to that.
Yeah, we could answer questions regarding anything. We're always available. Nights, I make myself available on weekends as well, which is a little bit tough for James on the weekends. But either way, we're there. We're here to answer questions, to be helpful. We're not going to put you into a loan that doesn't make sense, because we're looking for customers for life. That's what we do.
Yeah, we one of the things we for our followers, we preach the free refinance program.
Sure.
It's just not something that is really there today. It's there, but it's not. First of all, we were doing that for so many of our borrowers over the last year and a half, 2 years, that got mortgages around 6.75 to call it 7.25%, 7.5%. People who got rates in that range when they bought. In September, we did multiple refinances where we gave the borrowers rates in the fives, 30-year fixed, where it was free. We paid all the closing costs. We paid all the closing costs for them. No costs, okay? And then the 10-year treasury skyrocketed. So the point is, we can't do that right now, but that's coming back, okay? And we're trying to offer people an alternative right now to save money. And most people have credit cards, other bills, other debts, or, another expense or a home repair. HELOCs are cheap now. Take it now. And here's the thing. If prime keeps going down, which we do expect it to, although it sounds like the Fed has taken a couple of cuts off the table this year, there's still cuts on the table. Mm-hmm. So that 7.5% prime rate should go down further, probably into the 6s by later this year is where the forecast is at right now. Mm-hmm. So, and as soon as the free refinance is back on the table, that we'll be there for you. But, also once you become a customer with a HELOC, you're in our database, and we're going to let you know when those free refinance opportunities are there without you having to ask. We'll just reach out and say, hey, Mr. and Mrs. Smith, here's your free refinance is available now.
Our system notifies us that, hey, this loan that you did for Mr. and Mrs. Smith, well, you could refinance them now, or combine a first and a second and get them low rate and another free refinance. So, and we can take you to alternate terms, whether it be 28 years, 27, 26. Hey, I've been in this loan for 5 years. I don't want to go in reverse. Okay, let's do a 25-year. Let's do a 24-year. As long as the saving is worth it and it's competitive, it's a no-brainer.
Yeah, we're getting creative. In 2025, it's time to be creative. And there's no more, I don't want to tell everyone, the rates are going to drop by this time or anything like that anymore, because everything changed a lot when the Feds pivoted in September, and things have not unraveled like they normally do. In the past, typically when the Fed cut would start, mortgage rates would also come down, with the 10-year treasury yield would come down, and there's a lot of other factors with the economy and just growth and jobs and fear of inflation, going back up. There's too many other factors right now that things are not following suit. Although Anthony and I both expect once the presidential, change happens next week, that, I think the new administration is going to be anxious to help, those borrowers who really need to save money. And, let's face it, buying homes has become very, very expensive, and it's the least affordable
Difficult.
and most difficult it's been, in my lifetime, by far. And I feel really bad for those families that are trying to buy their first starter home. They're just getting there on their feet, and it's not as easy as it was, affordability, and we want to help as many people. So I do think the president is gonna, and his administration will that'll be a big focus pretty quickly out of the gates.
I think they should shake things up a little bit. Sure.
That's our feelings.
And here's the good news, folks. You take a home equity line of credit, guess what? If there are any fees, those are tax deductible at the end of the year. So it can help give you a bit of a tax benefit. And you're going to be paying mortgage interest, which is tax deductible. Can you write off your credit card debt at 22, 25%? Sorry, you can't. So this is a good way to help yourself out at the end of the year with your taxes.
Yeah, we're clearly not tax advisors, but
definitely not.
In many cases, a home equity line of credit is tax deductible. The interest on it is tax deductible. In many cases, talk to your CPA. But yeah,
of course,
it's a good point. Another good point. Just another way to save money, right? Anything else you want to enlighten our viewers on for 2025 in our world of exciting mortgages?
Well, as we talk about the values that continue to go up, even though the rates are still a little bit high, it's not a bad time to get in, because when the rates do start to drop, your values are going to continue to go up. So it kind of goes hand in hand. Be in it to win it. But we're here to help you get through it every step of the way. So looking forward to working with as many people that need their hand held in buying, refinancing, or taking a line of credit. Forte Financial.
Yeah, if you're in, okay, so right now, I think things have changed a lot with regard to listings, homes for sale, values. We're licensed all over the place. We do a lot of business in Florida as well. Florida has changed a lot. In the last year, especially a lot, where there's a lot more inventory coming on the market. Homes are sitting. There's a lot less showings, and that's all over Florida. That's happening. In the Northeast region, Connecticut, New York, New Jersey, Massachusetts, in a lot of these areas, there's absolutely no inventory. Just in our headquarters is in Ridgefield, Connecticut, right? And Ridgefield is a pretty big town. It's pretty big. 24 homes are on the market.
It's insane.
24 homes. That's it.
Yeah.
30 closed in the prior 30 days, and only 8 more came on. And the point is, in areas like Ridgefield, when rates drop, these values are only going to go up. So it's going to make it harder. I don't want to discourage anyone, but those of you who are nervous, the point is I'm trying to help you. If you are looking to buy, but you're worried about the rates being elevated, and you're in an area that has no inventory, but you find something, I'm going to urge you to consider it, because if you buy it now, and your rate is 7%, you're going to be able to refinance when rates come down. But if you would have waited till rates came down to 5%, you may be paying 10% more for that house. So don't be caught in that situation. A lot of people are just like, I'll wait for everything to come down. We don't know. Things may not come down anytime soon. They may not. It's things have really changed. Like it's not across the board anymore. Every area is completely different. Where in the past, there's always areas that were, went up and down more than others, but it's never been more divided than it is now. Never. There's some areas that prices have gone down dramatically, and the homes are everywhere, and in those areas, I don't think there's any rush for those buyers, in terms of if they want to wait for rates to come down. I don't think, but in areas like this, it's going to make a big difference because if it's scarce, it's going to get more scarce when rates come down because everyone that's on the sidelines is going to come in, and now you're going to have more buyers on the same homes. It's not, unless rates really come down low, like really low, like 3%, 3.5%, rates like that, like we saw in 2020 and 2021. If rates do come down that low, which who knows, I'm not saying that's going to happen or not.
You may see the inventory rise.
You're going to see a rise in inventory because then people will, all those people who kept their homes because of their rate, now they go, well, I can get the home I really want now, and I'm not going to have to pay a higher rate, or it'll be close enough. Then you'll see inventory come on in these areas, and then you'll see housing prices stabilize. I mean, this is what happens when, you do this and then you do this. Like, that's with values. So that's just a little bit of our thoughts here. But we're here to save you money. Please reach out to us. The best way to get in touch with us, honestly, send us an email at info@fortefinancial.com. Visit us on our website for more information, and we'd love to help you out. Anthony, anything else you want to say?
No, it's been a pleasure. Thank you for having me today, James. I do appreciate it.
It's been a while, overdue, and
way overdue.
I know everyone loves seeing you on the show, so Anthony will be back again real soon.
Looking forward to it. Thank you so much.
All right, thanks.
Got a little